Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, The Guardian and The Challenger go head-to-head on the case for gold. 65% returns exposed the biggest lie in British investing. Let's get into it.
Gold returned 65.2% in 2025. The footsie all-world managed 23.1%. Every balanced portfolio model, every just buy a global tracker platitude got demolished by a lump of yellow metal. It's time for an honest reckoning.
Congratulations on that 65.2%. Now tell me what gold paid you while you held it. Zero. Not a penny. Not a single dividend check. That gain exists purely because someone else agreed to pay more for your inert metal than you did.
You don't need dividends when your capital is compounding at that rate. Gold has outperformed equities over the last 18 months by a margin that makes dividend yields look like a rounding error.
But that's exactly the kind of recency bias that gets investors burned. Over the long term, equities with reinvested dividends absolutely crush gold. The data going back decades destroys gold's case.
Does it though? Because the last 5 years, pandemic, inflation shock, geopolitical chaos, have shown that gold does exactly what it's supposed to do, and then some. This isn't a one-year fluke.
Sure, gold spikes during crises. But British American Tobacco shareholders collected 5.72% in dividends last year. HSBC holders pocketed 4.73%. BP paid out handsomely. That income compounds whether markets are up, down, or sideways.
And how did those share prices perform? BP has been a disaster for years. You're collecting dividends on a melting ice cube. Gold doesn't cut its dividend because there's no dividend to cut.
Fair point on BP's price, but that's one stock. The FTSE 100 as a whole yields around 3.5 to 4%, and those companies are generating real earnings, real cash flows. Gold just sits there.
Gold just sitting there returned nearly 3 times what the FTSE 100 did last year. And you can hold it in a SIPP or ISA through ETFs, so it's perfectly tax efficient for UK investors.
With gold now above $3,000 an ounce and heading toward $5,000 territory, you're talking bubble dynamics. Every asset that triples in a few years eventually reverts. Who's buying at these levels?
Central banks are buying at these levels. China, India, Poland, they've been hoovering up physical gold at a pace we haven't seen in decades. This isn't retail speculation driving the price.
Central bank buying can reverse just as fast. And here's what really matters for UK investors right now: falling interest rates are an equity tailwind. As rates come down, discount rates drop, and equity valuations expand. That's basic finance.
Falling rates are also a gold tailwind, lower opportunity cost of holding a non-yielding asset. That's literally one of the primary drivers of this rally.
I'll give you that, but equities benefit doubly from valuation expansion and from lower borrowing costs boosting actual earnings. Gold only gets the opportunity cost effect.
You keep talking about theoretical advantages for equities, and I keep pointing to actual returns. The portfolio insurance argument for gold isn't theoretical anymore, it's insurance you actually collect on.
Insurance you collect on once, maybe twice. Then you hold it for a decade while equities compound at 8 to 10% annually with dividends reinvested, and you wonder why your portfolio underperformed.
That 8 to 10% figure includes some truly horrific drawdowns. The FTSE 100 is roughly where it was in 1999 on a price basis. 27 years of going nowhere without dividends.
Which is exactly my point: dividends are the return. You can't just strip them out. Total return is what matters, and on a total return basis the FTSE 100 has done perfectly well over that period.
And gold has done better. Adjusted for sterling, gold has massively outperformed UK equities since 2000. That's a quarter century of data, not recency bias.
You're cherry-picking the start date. Gold was at a generational low in 2000. Start from 1980 when gold peaked at $850 and it took until 2008 to break even in real terms. 28 years of dead money.
And equities crashed 50% in 2000 to 2003 and again in 2008. Every asset has ugly periods. The question is what's happening now, and the structural drivers, deglobalization, fiscal deficits, central bank buying, favor gold.
If you want a real inflation hedge in a UK portfolio, look at energy stocks. They generate cash, pay dividends, and their revenues are directly tied to commodity prices. You get inflation protection with income attached.
Energy stocks come with transition risk, regulatory risk, and political risk that gold simply doesn't have. Shell and BP are one windfall tax away from another dividend cut.
And gold is one shift in central bank policy away from a 30% drawdown. At least energy stocks have earnings to fall back on. Gold's floor is whatever someone's willing to pay for jewelry.
Gold has been a store of value for 5,000 years. I'll take those odds over a FTSE 100 stock that might not exist in 50.
Storing value isn't the same as creating it. Companies innovate, expand, hire people, and return capital to shareholders. Gold does none of those things. That's the fundamental difference.
Look, I'm not saying go 100% gold. But after 2025, anyone still dismissing a 10 to 15% gold allocation as a pet rock is ignoring the evidence staring them in the face.
On that we partially agree. A small allocation as genuine portfolio insurance is defensible. But building a thesis around 65% returns continuing is how investors get hurt. The income from equities is real, reliable, and compounding every single quarter.
The counter-arguments against gold have never been weaker, and the structural case has never been stronger. 65% in a single year proved that beyond any doubt.
One spectacular year doesn't change the fundamental truth. Gold pays you nothing, and over a lifetime of investing, compounding income is the most powerful force in finance.
The Guardian, The Challenger, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.